Hello everyone again. I'm sorry for my voice. I've got a really bad hay fever and my nose is really blocked. But I'm really trying to get another video out because it's been like 5 days since the last one. In this video, I'll dig into the market maker model and explain how to use the Cronus model, which is the model this whole series is about. First of all, let's talk about failure swings. Now, after the low or the high has been put in of the smart money reversal, a failure swing should form afterwards, and this is a low risk buy or sell. Now, a failure swing is when another high fails to take out the highest high and then expands lower. But obviously here I say upwards, but that's for the low. So let's say we have a low, move up, take out this low, move down, up again, down, swing down, don't take out the lowest low, and then move up. That is the failure swing. I'll show you pictures so it's easy to understand. So if we look at this market maker model, as you can see here, we have the smart money reversal here as we break structure. So this is the reversal here. And then, as you can see, we form a low here on the reversal. This is the long-term low. Then we get a failure swing. This is a price swing that fails to take out this low. And then we expand upwards and we create fair value gaps inside here. So this will be the low risk buy. We should never want to participate in the low risk buy. We should wait for this to form, wait for another high to break, and then look to get involved either here or here. That's what we want to wait for. Yeah, as I just said, a trade should never be opened without the failure swing forming. Yeah, ingrain this into your trading plan and see an instant increase in consistency. And I'm not just saying that, honestly. I'm not going to, but I can show you some of my DMs with the market maker model trader, yeah, it's just funny how completely erasing the low risk buy entry point from your model just skyrockets your win rate. Now let's get on to the Cronus model, which is what this whole video series is about. The Cronus model works hand in hand with the market maker model to produce a high win rate model. Now don't get me wrong, the market maker model is already a solid model and it's brilliant, and I highly suggest you get into trading it. Now, we use a very specific time frame blend for the stages of the market maker model. Now, just pay attention here. So instead of the normal approach of looking at the higher time frame, so let's say 1 hour, 4 hour, let's say look at the daily, takes out a high, then you instantly move to your execution time frame, which might be the 1 minute or the 5 minute or the 15 minute. Instead of doing that, we use 2 time frames. So they must go hand in hand for the model to be present. The time frame pairings must go hand in hand. Once again, this just increases your win rate massively, and if you just wait on one of the time frames for the fair value gap to form and then dig lower into the lower time frame pair, you'll see better, and you won't take as many trades daily probably, but you will eradicate some of the losses. So now, how do we blend the time frames together? Let's dig deeper into this. Okay. So here we have the typical market maker model. Again, we have the low risk buy here with the failure swing. Then we have the first stage of accumulation because we take out this low here, into a fair value gap here, and then dig lower, reaccumulate, and that's a silver bullet. That's where we want to enter, or here. Now, one of these stages must dig into their corresponding time frame pair fair value gap to be a valid Cronus entry. Now, what do I mean by that? So this either this low risk buy here, a 5 minute fair value gap. This is the 1 minute time frame. Let's say a 5 minute fair value gap must form inside of this price swing here, or a 5 minute fair value gap must form in this price swing here, or this price swing here to be valid. Now here are the time frame pairs. So on the left we have the market maker model stage time frame, so the low risk buy, accumulation, reaccumulation. That's the stage, that's what I mean by the stage. And on the right we have the fair value gap time frame required for it to be a valid Cronus entry. So if you're taking a 1 minute low risk buy, a 5 minute fair value gap must be present at that point. But you should not take the low risk buy. However, if the low risk buy forms off a 5 minute fair value gap, you can take that as a Cronus entry because now you have that stage on the 5 minute fair value gap. You can now look for the accumulation on the 1 minute time frame to go higher, because only one stage of the model, the market maker model, has to have the 5 minute fair value gap interaction, right? Then we have the 5 minute and the 15 minute, and the 15 minute and the 1 hour, and the 1 hour and the 4 hour. Now, I know what I've said is probably a bit complicated for you to understand right now, but I'm going to get more into it, and we're going to look at examples and everything, and you're going to understand it. So again, we have this is a very basic picture, basically, of a market maker model, but this is the Cronus version of the market maker model. So here here we have the low risk buy area, the failure swing, like I said. No 5 minute fair value gap here though, so there's no Cronus interaction here. Now, here we have a 5 minute fair value gap form here. So the accumulation leg digs into the 5 minute fair value gap and then moves higher. So now we have validified the market maker model. It is now a Cronus entry model, and we can enter off the reaccumulation because we've confirmed that the 5 minute fair value gap is supporting the market maker model on the 1 minute. So now the reaccumulation leg will be entered here, stop loss below here or here, targeting the original consolidation or a high time frame draw on liquidity. Now you might have a few questions. Now one of them might be, do we need, on the fair value gap time frame, which is the higher time frame out of the pair, do we need a market structure break? Do we need any bias on that time frame? No. The fair value gap is all we need. The 5 minute fair value gap is all that is needed to validify the 1 minute Cronus entry model. Once you have that, you can just get on the 1 minute and focus on trading the 1 minute. You don't need to focus on the 5 minute after that. Now here, I'm just going to get into some examples. So now on the pound, US dollar, we have buy side purged. So this is going into a bit of the high time frame bias, but we'll get into, that's going to be my next video. But I just wanted to get this out there now so I can answer any questions about it, etc. Now, yeah, so buy side purged, sell side here, 1 hour fair value gap here to target. Now for this Cronus model, we're going to use the 5 and the 1 minute pair. So what we need is a 5 minute fair value gap to then look on the 1 minute for a market maker model stage to unfold. So as you can see, this is the 5 minute here, and we have the 5 minute fair value gap here, here. We also have a short-term high rated inside the fair value gap. Now here is the model on the 1 minute. So we found the let's just go back. We found the 5 minute fair value gap. This is what we need for the Cronus to be valid. Now we're on the 1 minute time frame, and now we're going to mark out our stages of the model. So here we can see we have the smart money reversal. Then we have the low risk sell. We don't want to enter here, we need to wait for this to form. And then we have the 5 minute value gap getting traded up into here originally. So it formed here, but we started trading into it here and here. But as you can see, we formed equal highs. So this is low resistance liquidity. It's unlikely that we'll trade lower with these highs still intact. So while this might look like an attractive entry, it's not valid because we have not taken out these highs. Here we trade up, we retrace on the 1 minute to the 5 minute fair value gap once again, take out these equal highs, take out this high, form the distribution, move down, break this low, form a fair value gap here, and this is where the redistribution happens. You could argue it happens here, you could enter off that 1 minute fair value gap there, you can wait for the break in structure and then this fair value gap, but I would say this is the redistribution leg. This is where you want to enter, or here. So you want to enter on the distribution leg or the redistribution leg. You could have entered at this 5-minute fair value gap with your stop above the low risk cell, targeting the lows, or this fair value gap here, or 2R, whatever you want to do. You could have entered here, stop up here, because we have the 5-minute fair value gap that validifies the Cronus entry model, and it makes the chance that the high above the 5-minute fair value gap on the 1 minute is going to hold, and we won't trade through it before we take out the original consolidation. So I just want to say something that really clearly identifies why I use this model now, and not the market. Well, I do use the market maker model, but I do use it. I just use it slightly differently, because I found this was happening quite a lot, right? So this is your typical market maker model, right? So we have the smart money reversal here, low risk sell, distribution, high, break lower, fair value gap, redistribution. Like, I would enter on this redistribution here, and don't get me wrong, that's a valid market maker model. That's valid. Like, you will take that loss and be like, that's fine. You know, I traded how I was supposed to trade. But if we use the Cronus side of things here, I'm just going to mark it out live. So the Cronus side of things is this, right? So in here we have no 5-minute fair value gap that's reacting off. But this high being put in might create a 5-minute fair value gap. So let's remove this. This might create a 5-minute fair value gap. Let's say it's here. Let's type it out. 5-minute fair value gap. Right? So this could create a 5-minute fair value gap. This is not the redistribution, or this is not the distribution. Now this is the distribution, because now we have that time frame pairing. We have that 5-minute fair value gap being created. We have that extra level of validity. Now, we have no reason, once we trade into this 5-minute fair value gap, we have no reason to go up into it. But after we create the 5-minute fair value gap here, you know, the market wants to move into the 5-minute fair value gap before we move downwards. So this kind of invalidates this little redistribution here. And then once we move higher, a lot of the time I was thinking, well, how can I remove these losses? Because these were my losses. I was still profitable with the market maker model, but these were my losses. And then I identified, one day I was like, I sent the message to the market maker trader. I said, yo, look at this. I've kind of discovered this in a way. And yeah, and now here I am. Now this would be the distribution. Right? Because now we've interacted with the 5-minute fair value gap. And then this would be the redistribution. Right? Because this is we've interacted with the 5-minute fair value gap. Alright? Now that's one way that's how I'm going to describe it. That is my best way of convincing people in a way that this is why you should really look into this. Alright, thank you. So as you've just seen here, you can see the colours of the lower cell, distribution, and redistribution. Now I use a traffic light system. So I use certain colours on the charts to decide if I should enter or not enter. So I'm reminding myself, basically. I mean, I don't do this as much anymore, as I've been training this for over a year now. However, I would recommend you start doing it, just so you know when to enter and when to not. So red, like a traffic light red, do not enter. We're waiting for the orange to appear. Alright, orange, which is the amber, we consider entering. It is safer to do so now, so we can definitely consider an entry at the orange, which is the distribution leg or the accumulation leg of the market maker model. Green, all foot on the gas, let's enter, let's get in the trade, because now we have the distribution leg and the low risk sell, and we should enter, because that is our highest probability. Now I have another example here. We have a GBPJPY, takes out this high time frame low, sell side is purged, and then a 4-hour fair value gap is formed just here. We have buy stops here that could be a target, buy stops here as well. Now, as you can see, we don't have any sort of structure, break, anything here on the 4-hour. We just have the fair value gap. That's all we need. Now for this one, we're using the 4 hour and the 1 hour pair. So we have the 4 hour fair value gap and the 1 hour market maker model. So as you can see, we make the low, move up, create a high, move down, and then move up again. So this low fails to take out this low here, which means this is the failure swing, and this is a low risk buy. This is also inside a 1 hour fair value gap, which increases the chance that this low will not be rated. So we have the failure swing, which is the low risk buy. We don't want to be entering here. The 4 hour fair value gap hasn't formed yet, and we don't enter at low risk buys. So now we have this expansion upwards. This expansion here forms the 4 hour fair value gap. Now, once we're trading inside here, we should be looking for the reaction off the 4 hour fair value gap on the 1 hour to find the reaccumulation leg and the accumulation leg of the model. Now, as you can see, once we trade down into it, we react upwards, break this high, and then we've confirmed this is the accumulation leg. It's unlikely that it will trade below this low. And then we get a small retracement and we reaccumulate and move up to the high. This is the original consolidation. Alright? Now, lows that form inside of fair value gaps created by the time frame pair, the higher time frame pair, are much more likely to hold and show actual accumulation of orders taking place. Short-term lows that are sitting above the higher time frame fair value gaps are likely to be raided into it and then move into the direction of the model. Now, what I mean by that, you see this short-term low here, this short-term low here. We're unlikely to move up from here without executing on the 4 hour fair value gap. So these lows are taken into the 4 hour fair value gap, and then we move higher. Now the reason the Cronus model is so effective is because you might want to enter off here because we get the low risk buy, and then we have the accumulation here and the reaccumulation. That could be your thought process, right? Because we have a low after the low risk buy, trades down, creates a fair value gap here. But the way I see it is the 4 hour fair value gap adds such a high percentage of likelihood that the low form inside it will hold and the model will complete. Now I used to find that models that I was looking at would not complete because they would need to retrace into their higher time frame pair fair value gap. But with this model, you can completely you miss out on all of that. You miss out on all the negatives of the market maker model essentially, because you don't need to be worried about it retracing into a slightly higher time frame fair value gap because you've waited for it to do that, and then you enter. So there's no need to retrace on the higher time frame pair, and it's likely that the model will rally or expand lower after the accumulation or reaccumulation leg forms. I hope this makes sense. I know it's a little bit complicated, but I'll pump out examples, I'll explain, I'll answer questions, I'll try as hard as I can. But once you get it, I promise on everything, this model is something you need to look at. Now, how to ingrain the model. I've not got any right in here because I know what I'm going to say. So what you want to do is, you don't want to backtest it. You don't want to I don't agree with backtesting. It's not backtesting. You want to look back through old examples of it happening so you can familiarize yourself with it happening in the future. So you want to go back through your charts. You want to use that higher time frame pair. Take a screenshot of that, the fair value gap forming on that time frame, and then move down into the lower pair and show the market maker model forming at that fair value gap. You should accumulate hundreds of screenshots of this happening, and I just want you to look back and see how effective it is, and how you will likely catch the expansion of the market maker model, as you don't need that retracement up into the you're not going to get stopped out with your stop when it's on a higher time frame pair fair value gap, because you've already waited for that interaction to happen. So there's no need for it to go up again and take out that high. You see what I mean? I hope this makes sense. I've looked at many different ways of explaining this, and it's not something that you can. It's not simple, right? Okay, it's not simple, but it's rewarding. And once you get that, you'll be set.